is it one or the other? Is it TFSA or the RRSP or both, right? So tonight's conversation is just trying to make sure that you understand that it could be for some people, it could be one or the other, while another person, it could be both. And I mean, each person will be slightly different. So we're going to talk and speak to the tax benefits, maybe what types of investments you would like to or would be best in each product, because the TFSA and the RRSP, they're not actual investments themselves. They are what we call structures or a vehicle in which you can add any kind of investment or real estate or REITs or crypto or whatever. You can put just about any type of investable asset right into the TFSA or the RRSP. It just all depends on what you want and what you need and where you are in your journey. I mean, the younger you are, the more aggressive you can be with your investments in both, and especially if it's more for long term. And for someone who's maybe reaching closer to the period in which where they're going to use it, they may make it a less aggressive, maybe more conservative or more growth, so that they're not in more volatile style investments when they're going to start to maybe deplete or pull on and live on the income from those sources. And I'm assuming that, the TFSA you're also using for retirement. You don't have to. TFSA could be used for goals today, right? In one of our presentations previous, I talked about how you can use the TFSA for emergencies or for building your travel fund, or, if you want to use it to save for a home, you can also use it for that purpose. But typically, I'm speaking to, maybe using it as a vehicle and a way to build for future, right? So whether it's future for you for your own retirement or for children or for generational wealth, you can use these tools. And so let's get started. The goal is, to ensure that you understand what we mean by the tax-free savings account or TFSA, what we mean by the RRSP, the Registered Retirement Savings Plan, and that they're both tools that you can, as I said, accumulate money or accumulate investments in. Then we're going to talk to the key differences and tax advantages, the best investment options for each, because, you don't have to invest exactly the same in both. You can change it up depending on what your goal and strategies are, and especially based on what each of them offer you in terms of taxes and deferred taxes, or whether they give you a deduction, because the RRSP will. So you can choose the investment options based on the product, like whether it's a TFSA or an RRSP. Then we'll look at some pros and cons, choosing the right one for you, or both. As I said, it could be both. And we're going to wrap up with a poll. And so think about it as you go along. Which one fits your needs best? Is it the TFSA or the RRSPs, based on what you're thinking about for yourself, both today in terms of short-term goals and long-term goals? And then we'll wrap with takeaway and next steps. So this year, as I said, I changed up my year a little bit, and I've been focusing largely on not just doing real estate investing, but focusing on doing financial education and financial literacy in general, so that for some of us, real estate could be a great foundational tool for our portfolio, while others may choose not to invest in real estate, maybe actively, but maybe passively. And so I'll have financial webinars that I offer, and those are usually free to attend, and you can learn about how to manage money, build wealth, and achieve financial independence. That's the whole idea of the webinars, and I host them monthly, last Thursday of the month. As long as we continue to see interest, we'll continue to offer that. I also offer credit repair services, and it could be, just for some people, repairing. I feel even for myself right now, I'm doing a little repair, but it could also be just if you are maybe just, a little bruised, depending on what's going on currently in the market or in your own personal life, we can rebuild. And of course, for someone who has pretty good credit, we can also show you how to strengthen it and how to use it to build your future financial, your financial house, because I don't think that people think about how their credit can be used to do that. And you can, right? I always talk to sometimes people are struggling saying, well, I don't have capital. And they think that that's having money is the only way that they can partner and invest with people. No, you can bring other assets to the table as a joint venture partner. You can bring your credit. You can bring to the table your income. You can bring your knowledge. You can bring your time. There's so many other assets that you can bring to the table that isn't always capital. But you have to, be willing to share with a partner or a potential partner what assets you have. And capital could definitely be one, because capital is typically one of the things that obstructs people from being able to do things like invest in real estate, invest in any type of investment, such as the RRSPs, tax-free savings accounts, and so on, right? So we also, my goal this year, and I have been, it's one of the things I've been licensed, I've been licensed in the financial services industry for over 20 years, over 25 years, with my insurance license, my investment licenses. And I used to teach for one of the companies that I work for, Primerica. I taught their licensing courses. And so I've been doing that stuff for a long time. But, the past few years, I've been largely focusing on real estate, and I'm coming back to that focus now, as well as recently, Brandon, which some of you might know, has asked me if I would consider, getting my mortgage license, which, by the way, I've got, and I'm now a licensed mortgage agent, and so I can practice. I've been working with Brandon for some time with clients, but now I can also, use my license as well. So we do offer mortgage solutions, and mortgage solutions are great. Not just, it's great for obviously properties, but I can still bring to you solutions like investing in properties that may not be it may be more the passive style. If you have capital, you can invest passively and earn and have your money grow. So it doesn't always have to be mortgage solutions like buying a property. Okay. But what is a TFSA? Please unmute and maybe tell me what you know about it already and what you're familiar with in terms of the TFSA. Anyone? Hello?
Okay. So
go ahead.
How I know it is as it's a place that you can put money, depending, I think after 18, a certain amount per year.
Mm-hmm. Do you know what the current limit is, or the current amount is this year for anyone?
No, I don't know.
Okay, that's okay. It's 7,000 right now as of this year. It's 7,000. It changes from time to time. When we first started, it was a $5,000 contribution, and then it's increased over time. So, yes, great. Thanks, Jermaine. Anything else? And it is for someone who is age 18 and greater that's eligible to contribute. No? Okay.
I can add, Andrea, that you are not taxed on your capital gains that are made within the TFSA.
That's right. Excellent. So, and that's one of the greatest feature of the tax-free savings account, right? It was one of the ways that the government opened the doors for us to be able to earn money without taxation. And it's not just capital gains, but it's any way that you earn income in that savings account or vehicle. So if it's dividends or capital gains or interest, you don't pay taxes on that earnings or the growth, which is phenomenal, right? It allows, if you were here when I talked about compounding of interest, it allows your money to grow much faster because now you're not subject to any taxation, and you can really just have the money reinvested, or you can take it out. It's all up to you. But the tax-free, it allows you to grow your investments absolutely tax-free today and forever and ever, right? It's the contributions that you do make into the tax-free savings account. They are not tax deductible. So you can't use them to reduce the taxes that you've paid on income elsewhere, such as your employment income or other investment income that you might earn, or property, income that you might gain. So it doesn't allow you to use it as a deduction. So, but another benefit is that all the withdrawals, right, including the growth and the capital gains that you mentioned, Kelly, it's all tax-free, which is that's one of its other biggest benefit. The contribution limits, as I said, they have changed and increased over time. It would be great if they continue to increase it, because it is one of the few ways that you can earn income, and it could be any kind of income and not pay taxes on it. Meaning, typically income comes in the form of capital gains, dividends, or interest. Okay, and so it's amazing to have a source, place that you can invest and not have to pay taxes, because it's very rare. You make money and the government wants to earn a portion of it. And so right now, any amounts that you haven't used is there to be used indefinitely into the future. Okay, and so you can, and if you, for example, in 2024, say you might have taken out, you had a TFSA, maybe you accumulated money in there and you took some out last year. Well, the amount that you took out, it meant that you now have freed up that room and you can put it back in. Not in the same year, you can't put the amount back in the same year, but the following year and on. So if you took out in 2024, the amount that you took out, say you took out 5,000, it meant you now created a 5,000 room that you can still use again in the future, just not in the 2024 year. So this year you can put back the 5,000 plus the other 7,000 that you're entitled to this year. So each year that you take out, it gets carried forward, and you can use that as room going forward, as well as any amounts that you don't use can be used and carried forward, which is an excellent way. So you ever come into a large sum of money and you have $50,000 of tax-free savings room, or even the max right now, which is just a little over 100,000, it's just around the $100,000 mark, you can put a whole 100,000 into your TFSA and start having money grow tax-free in there. So what about the RRSP? What do we know about that? You tell me some understanding that you may have first. And anyone using it, because if you're using it, you might have a better sense. If you're not using it, maybe not so clear. Anyone? Jermaine? Kelly? No?
So I will say that I am using it, but I don't have a clear understanding of what it is, or maybe how to effectively use it. So like the TFSA, it's a vehicle where you save your money, but it's for retirement.
Okay, yeah, excellent. I agree. It's for, the whole purpose of it is for retirement. You do have, I don't discuss it much here, and I have spoken to it probably before, but outside of retirement, if you needed it as an adult for post-secondary schooling, you could use it for that. It's called the feature that they allow you is called the lifelong learning plan. And so you can't use it for children's education, but you could use it for your own education. So say you're 30 or, or 40 or whatever, and you want to go back to school for something and leave your job so that you can move into a new field, you can pull from your RRSP for that purpose. There is an expectation that you're limited to how much you can take out. I believe it's 10,000, and you're expected to pay it back in a period of time, over a period of a certain period of time. And if you don't, then that amount that you pulled out is going to be added to your income and taxed accordingly. So you can use it for the lifelong learning plan, as well as you can use it for the home buyers plan. So the HBP, where again, you're limited to a maximum amount that you can take out, which I believe is around 35,000 per partner. So if you have two of you, husband and wife, or two partners, you can put in 30,000 each or 35,000 each. And so you can each pull it out. You have 15 years to pay it back. And it's, you know, the expectation is that you pay it back in small increments over that period of time. If you don't pay back in any one year, the amount that was entitled to be paid that year gets added to your income again, and you're taxed on it accordingly. So the RRSP is good for retirement, absolutely, but you can, along the way, use it as it's almost like you can use it as a loan to yourself, for the purpose of buying your first home, or going back to school as an adult. Okay. But the goal is really to save for your retirement. And it does allow you to, I'm assuming, Kelly, you might be using it at work, maybe? Do you know? Is it at
That's
work?
correct.
Yeah. And so I think it's an excellent tool to have in many workplaces, and especially if your employer encourages you to put in, because they will also contribute. They won't typically make any deposits into it if you don't. And so if you agree to set up the RRSP, they might have what they call the group RRSP, so they'll just have a G before it, and they will contribute in that for you as well. So they might match up to, say, you know, a certain percentage or a certain dollar value. And, you know, I know my husband, we use that at his work when he was there. A lot of the guys are turned off by it and they say, no, I don't want to do it. But I'm like, it's free money. You know, if they're going to put 100 and you put 100, and then, you know, it's almost like free money, free growth, as well as now you can have it invested and growing for you. So it makes absolute sense to do it, Kelly, if you are at work doing it. And as well, you get the tax deductions. Now, you get the tax deductions for the portions that you put in. And so if you are employed and you don't have too many other expenses to offset your income, the RRSP contributions that you make is just that. It allows you to reduce your total income so that what you're taxed on is lower, and hence you could potentially get a rebate of some of the taxes that you may have paid in the year prior, right? Because right now it's tax time. And so if you're filing your taxes for 2024, if you made some RRSP contributions last year at your work or at a bank or an institution, that amount gets filed along with your taxes, and it can reduce your taxes that you would have paid last year. And in most cases, for most individuals, depending on if they, you know, their scenario, they are likely going to get a rebate of some of that the taxes they paid. And then you can have, which is also a huge benefit of the RRSPs, is that you get the growth that you are realizing in that plan. It's tax deferred. And so similar to the tax-free savings account, being tax deferred means that it can grow and again compound faster, because you're not expected to pull any out or, you know, to allocate any of it to taxes at this point. Yes, in the future, you know, you have to take account of the fact that you will have to pay taxes when you go to pull it out later in the future. And I will eventually come to, you know, talking about how it looks as you retire. But because a lot of us are in the accumulation phase, I've been focusing largely on, you know, talking about how to build and accumulate in the plans. But there is, you know, down the road, you can convert your RRSP into a RIF and start to use it to generate income, right? And so we can always speak to that another time. But the contributions that you make, as I said, will reduce your income, your taxable income, which for most people, you know, if you're putting in 10,000 into your RRSP and you earned 100, you know, 100 or 50,000, let's use a smaller number, 50,000. Now, instead of being taxed on 50,000, you're taxed on the 40. And that could mean a huge tax rebate. If you're in a, like, say, let's use a simple number, 30% tax bracket, you know, 30% of the 10,000 that you contributed could mean that you are eligible to receive about $3,000 in taxes back to you. You know, and that's simple math. I mean, I'm not accounting for any other sources of income that you might generate or any other, you know, sort of tax consequences that you may have to realize. I'm just keeping it simple. And so that could be, you know, a huge savings and a nice chunk of money back at tax time. And, you know, you can choose how to invest that or put it aside to pay down debt, or put it, into your tax-free savings account, or, whatever you want, right? Maybe an emergency fund, because that's one of the areas that I think is key. I've really, found in the last year, I've depleted emergency funds. I still have one that I'm not pulling on, but for the most part, with my mortgages all escalating substantially, it's been really tough. So I feel like, if I get any money coming in, I always try to allocate some of that to that emergency fund, right? And the tax-free savings account could be a great place to keep your emergency fund. So one other important feature of the RRSPs is that there are limits, right? For the 2024 year, the limit was $31,560. Now, not everyone is eligible for that $31,560 because it's based on income. So it's typically 18% of your income, up to a maximum of $31,560. If you're in, the six-figure income, like 150,000, you might be entitled to put the whole $31,560. But if you're, say, earning 50,000, it's 18% of the 50 that you can put in, and so you are. And if you're contributing the maximum, that's awesome, because especially if you don't have a pension plan at work, or you don't have any other source of retirement income, then it's an excellent way to build your own retirement. If you have other sources of retirement assets, like a pension plan that you might be accumulating at work, then you want to really talk to an accountant to make sure that you're not putting too much into the RSPs so that you pay more taxes in your retirement years, right? So, and those are things that you can just do it in the first 5, 10, maybe 15 plus years. But once you start getting closer and closer to 55, 60, you might want to revisit what you've done and see if it makes sense for you based on, assets that you have in a pension plan, CPP, and, the assets that you've been contributing to in the RRSP. The tax-free savings account won't affect your income, but all those other things I mentioned will. And so you want to make sure that you revisit and see, what will my tax consequences look like in retirement, and should I be continuing to contribute to the RRSP, right? Because then you might want to adjust what you're doing and focus more on putting it into the tax-free savings account, or just into, I was talking to Cheryl at the outset, there's many other vehicles that you can invest in that can give you tax savings along the way, and as you go to pull from it. So, and we, if you ever get there, we can speak to those. Some key differences. So, no, sorry, any questions before I move on? Because, as I said, I'm speaking to it in very general terms and trying to give you as much to help you understand just the basics. But any questions about either the tax-free savings account or the RRSP? Okay. So some of the key features and tax advantages. This is really just like a nice summary. And remember, I'm going to provide the recording for you, so you can always come back to it. And then you can always ask questions at another time too, depending on what you start to think about, or even if you go back and revisit your own plans or what you're doing. So one feature is the deduction. Remember, as I said, for the tax-free savings account, there is no deduction. It does not reduce your income that you've earned in the last year at all. It will, though, if you're contributing to an RRSP. And so if you are an employed individual with no other deductions, the RRSP could be a great way to get some tax savings in your working years and your accumulation phase for retirement assets. I would still encourage you to use the TFSA because, again, there is no taxes on withdrawals and the money is grown tax-free, right? So while the RRSP, the taxes will be paid at withdrawal, and it's paid at withdrawal whether you're retired or you're doing it pre-retirement. Okay, they have what's called the withholding taxes. And so if you ever take money out, they're withholding a portion that is then submitted to CRA. And depending on your tax, your tax liability, I mean, if you can know your tax liability today, you'll know, like, the higher taxes that you pay and no other source of deductions, the RRSP could be an excellent way to give you that sort of savings and tax rebate. And if you have no other, plans that you're accumulating income in for retirement, then it's absolutely the best way to build your retirement savings, right? Because typically your house, which many people think, oh, I'll use my house. Well, if you still need somewhere to live, you may not be able to use your house in the same way unless you're able to downsize and take some of the assets that you've accumulated in your home to invest to generate retirement income, and then downsize to something smaller, hopefully something smaller and less costly. Today, I don't know if that's the case for many people, because if you started many years ago, you probably bought your home for a lot less than you could possibly downsize to now and get a condo or a townhome, and that may be still fairly expensive. So you have to look at what makes sense, right? I mean, naturally, if you're selling your home for well over $1 million and you can buy a condo well under $1 million, you have, a good chunk of change that you can pull on to do that. And I mean, I can always speak to some of those scenarios, but the reason why the RRSP, I think, is good for most employed individuals is they are not necessarily accumulating money in a pension plan. Very few places offer pension plans today. I can think of a few, like the teacher's pension plan. Like, teachers get that. Many people in the teaching field have a pension plan, either through OMERS or through the teacher's pension plan. Or if you're an officer, you work for the city or you work for the government, you'll tend to have pension plans. But most people outside of those industries or those places of employment, they don't have pension plans. And even what you have at work at Kelly, it's not a pension plan. It's an RRSP or a group RRSP, and it's very different. Your employer is not obligated to, nor, they might start it and they may stop, or they may offer you, some maximum amounts, but it typically is not going to be enough for you to retire and have, enough to survive or sustain yourself. You will likely have to save and invest elsewhere, or you may be, again, reliant on some of the government benefits as well, right? But you'll probably need to do some more investments like the TFSA as well. I don't think that it's enough, because even if you do the max each year, you're probably in a better position, but most people are far off from doing the max when they're contributing to their RRSP and they have no other plan elsewhere. Okay, so it really is important for someone who's employed to use the RRSPs if they can. And I mean, everything I've ever learned and read says pay yourself first. And really, when you're saving and investing in these two vehicles, you're paying yourself first, right? Even if it's just 10% what you earn for your first 5-10 years, and then you increase that over time, right? So the tax-free savings account, the best use for it, I would say, it all depends on yourself, but it's good for both short and long-term savings. And you can set up multiple accounts. You don't have to have just one tax-free savings account or just one RRSP. I mean, I think one RRSP is a good idea, but for a tax-free savings account, I think it's a good idea to have two. One that's for short-term purposes that you can, say, use for emergencies, traveling, so that it's something that you're not putting it into very volatile investments that could drop and go down substantially, because maybe in 6 months to a year you need it for some purpose that is like comes up. Your car breaks down and it needs fixing, or someone passes away in your family and you have to travel to go to the funeral, just whatever circumstances that you may not be able to predict. And with the short-term TFSA, you can just pull from that fairly readily. It's typically, I feel, should be held in something that's more cash and easily liquidated, so that you can just access it readily. While I think it's also good, because it's a tax-free and it's growing tax-free, and it will be, pulled out tax-free, I think it's good to put it in something long-term that can earn really good returns, and especially things like interest, because interest is typically taxed very heavily, and unlike dividends and capital gains that give you better tax savings. And of course, our country's forever changing the capital gains and changing things around. So to have it in a place where it can be tax-free, the earnings in terms of capital gains, dividends, and interest, it's phenomenal. So you want to use it for long-term purposes as well, which may be maybe you have a 5-year goal to buy a home and you can save in that vehicle, or you have a goal of using the tax-free savings account for retirement purposes as well, right? Or, as I said, maybe building generational wealth, because if you have 2 or 3 different vehicles, or 2 or 3 different tax-free savings accounts, you can invest them differently according to the reason you're establishing them. And when I've set up for clients, I've often especially young people, I always encourage them to have one for short emergency style purposes, and the other for long-term, maybe retirement and or future purchase of a home or something, just so that they're separate and distinct, and we can take advantage of getting really good returns in the long-term vehicle while making the short-term one accessible for any time they need it, right? Because it's not restrictive. You're not paying taxes on it anyways, right? So you can pull it at any time you need it for any purpose that you need it. And that's one of the, I think, great feature of a tax-free savings account. And you can hold it anywhere. It's just, I would highly encourage not using a bank, because you may not ever get really good investment opportunities there where you can actually have it grow tax deferred and say it's worth it. I mean, the whole goal is, because it's tax deferred, not tax deferred, but tax free, you want to make sure that you're investing it in stuff that will gain the best returns, so that you are not having to worry about the taxes. And so, yeah, I think it's a good idea to avoid using the banks for your tax-free savings account. You might want to speak to us or talk to a independent investment firm to help you make better decisions as to where to invest those tax-free savings. Or if you're doing it at the bank, do it in a self-directed trading account where, or find an expert that can help you with a self-directed trading account. One of the things I'm going to start too in the next little while, because I've had some teenagers, if you could believe it, asking me if we could do some, if I could teach them how to invest and do some direct trading. And so I'm like, absolutely. I've been doing some of it myself and had some success. So we're going to talk about how to use, and so I'll offer that to you guys when we start that, so that you can also participate. You can have trading accounts through TD or Scotia, and I'm not sure about the other banks, but those are 2 banks that I know that offer it at really no cost to you, and so you can have access to really great stocks. The RRSP is taxed at withdrawal, and there are restrictions on how you can withdraw as well, both in the accumulation phase as well as when you're accumulation, meaning during the years that you're working and building up, and then in the withdrawal phase when you are choosing to now retire and pull. They have limits and restrictions on how you can withdraw. So just know that it's not it's structured, but it's the same, and that holds true typically for pension plans in general as well, right? Both the OAS, CPP, and any defined benefit plans or pension plans that you may have at your work, such as the ones I spoke of in terms of officers, teachers, nurses, those plans, they all have restrictions on how they can be withdrawn as well. Okay, but any questions about this slide here? No? So some of the best investments for each, again, it's going to depend on who you are and what you're looking for, what the purpose you're saving for. But if you're using the tax-free savings account, I would say it makes sense to focus on growth-oriented investments, because all the money is tax-free. So your growth-oriented investments is going to give you the best return on highest returns. And so that can include things from stocks to ETFs, to mutual funds. I always like to include things like crypto, because some of us may be investing in things like Bitcoin, Ethereum, and so on, right? So those are great to hold in here, because all the gains that you earn on those, they're not taxed, not now and not in the future, because it's free, tax free. It's the reason why you want to invest in the things that could give you the best earnings and the most. You can absolutely, when you're doing it for short-term purposes, you can absolutely use the banks, such as, especially the bank products, such as a savings account or a GIC or bonds, like Canada savings bonds or any kind of bonds, because they tend to be low risk, low return, and low volatility. So they may be great for someone who is just, using the tax-free savings account as a holding place for money when they need in the short term for emergency trips, maybe just, paying certain bills, like, if you have annual taxes that you have to pay, like me, you might just hold it in the short-term tax-free savings account so that you have that accessible to you, right? If you are thinking of, the RRSP as a structure, especially because you said you use it already, Kelly, then typically your focus is more long-term growth investments. And again, when you're thinking long-term, you should always try to get the best, portfolio filled with stocks, ETFs, and mutual funds, and, any other like REITs or whatever else you want to, add in there that can give you the best growth. And you also want to try to utilize and maximize things like your exposure to investing beyond Canada, right? Because the RRSP will allow you to hold, fund investments from across the globe, where you have a bigger market share than Canada. Canada is such a small, part of the globe that to keep all your money invested in Canada doesn't give you access to the great returns and opportunities that you can get by investing in equities of, foreign companies or different geographic regions, like the US, like Europe. Yes, those markets, Asia, they tend to be more volatile, but because you're investing for the long term and you're not needing it immediate, you often have time to, go through those ups and downs. And the markets are cyclical, so they're not going to stay down forever, and they're not going to be up forever. They kind of go up and down. And typically, when you look at over the long term, especially if you're looking at something like an index chart, or you're looking at the Toronto Stock Exchange or the New York Stock Exchange, the average returns tend to be somewhere in the double-digit return, somewhere around 12 to maybe even 15% return, because the last couple of years in the stock market has been phenomenal, like really good. And if you haven't been, taking advantage of those stocks, then you've really lost a lot of opportunity to earn, because the 2024, 2023 years, they were like 2.5 years of like just amazing returns. So, and you can only get that in growth type investments. Another opportunity with the RRSPs, because again, it's tax deferred, and even in the withdrawal phase, when you're depleting your RRSPs, it's not taxed based on whether you earned it as capital gains or dividends. It's just taxed as income. So it's a little heavy on the taxation. And so you definitely want to take advantage in the accumulation phase that you're getting the best possible growth and opportunities to maximize on growing that portfolio or growing your retirement savings. So using dividend stocks, so stocks like that, companies that share and give back in terms of dividends, and many companies do offer dividend to their shareholders or their stockholders. So you can talk to an expert to help you. You can talk to myself and we can help you find the right type of allocation. When you're invested at work like that, like my husband was, oftentimes I just reviewed his investment allocation just to make sure that he was taking advantage of, because, for the first, 15, 20 years, Dean was young and he didn't need, and he still doesn't need his retirement income as yet. And so we can still stay a little bit more risky and volatile, right? We can take more risk right now than maybe 10 years from now when we're maybe thinking of starting to pull. We may not want to have that same allocation. So dividend stocks, foreign investments, such as US stocks, and are really good to hold in your RSPs. I mean, even Europe, because these are markets, they're volatile, but they give you way better returns. Asia, so I do encourage that you take, I've showed an equal weighted growth portfolio here, but you don't have to keep it equally weighted. You could have, 75% or up to, 75, 80% in stocks, in even international stocks, and then maybe keep a small portion of cash and then, the balance of it in, some stuff locally here in Canada. But again, Canada is such a small market. I don't think more than 30% in Canada is good for anyone's portfolio. Some of the pros and cons of, the tax-free savings, we've said them many along the way, but just to summarize, the tax-free growth and withdrawals is a huge pro for the TFSA. The fact that you have no penalties when you withdraw, so there's nothing withheld, there's no tax consequences, there's usually not even any fees depending on where you're invested, right? So, and then there's no income limits, like you're not restricted by your income. You can, you're only restricted by the max that you're allowed each year and the unused amounts that you haven't used in previous years, or amounts that get carried forward that you may have used and pulled out. Some of the cons of that TFSA is that it doesn't give you any immediate tax deduction. So if you're looking for tax deduction, you're going to go to the RSP. It also doesn't have, your contribution room is limited to right now 7,000. And so you're not going to, if you go over, you're penalized. So you don't want to go over. If you ever go over, you just withdraw and take it out, because you will be penalized 1% per month on the extra that you've put in. So there's no value in over contributing. Okay. The RRSP, it gives you immediate reducing your taxes in the year that you've contributed, up to even the first 60 days of the following year. So you can use that to reduce your taxable income to generate a tax rebate. It's great for high income earners. I think they are the best served, especially if they have no other pension plans elsewhere. And it's a great way to save for the long term. I don't think that most people are saving outside of, being forced at work or using the RRSPs on their own. So it is an excellent way. And especially if you're not accumulating equity in a house that you own, right? The RRSP is the next best way to start building your wealth. The cons of it is that the withdrawals will be taxed as income. And again, you're not taxed as income based on how they're earned. You're just taxed as income. So it's like, you're pulling out 60,000 in, your retirement years. You're paying taxes according to what 60,000 of income would pay, right? So there is benefits to using, like when you're in a non-registered account. These are considered registered. When you're in a non-registered account, you can talk to me, because then it's really important that you invest in things that do give you tax benefits, right? The RRSP, the cons are that the withdrawals are taxed as income and no other way. You're not getting any tax breaks from dividends or capital gains. It's just income, right? So and that's why for some people who may be generating income through a pension, through OAS, CPP, it will put them into an increasingly higher tax bracket, and then they're paying more in taxes than they like. So that's why it's good to revisit and just check on, where you stand, maybe every few years, or at least as you get closer and closer to that 50, 60 years old, right? When you're thinking you're going to start needing to use it. And any early withdrawals, whether it be, during the 30, 40 or 50 years old, you're going to pay taxes. You're going to trigger a tax unless you're using it for purchasing a home or the learning plan that I spoke of. Okay. Let's try this. Now, it does require that you unmute and you join in. If you had 10,000 to invest based on some of what we spoke to and thinking of your own personal circumstances, where would you put it? Would you consider doing it in the tax-free, growth account or the RRSP tax deduction and retirement savings, and why? Jermaine, do you want to start? You've been gifted $10,000. What are you going to do with it? And why? Jermaine, are you there?
Yeah, I'm here. I'm just thinking. Can you hear me?
How you would use it too. Yes? Sorry, go ahead, Jermaine.
I'd put it in the TFSA.
Okay, and why? Why would you choose that for you?
It's tax-free, so it's like the growth is, I don't remember. If you pull it out, you're not penalized, right?
Yeah, you're not.
Yeah. So just based on my journey, like what I know, like I want to do, I want the liquidity. Like
yes.
The one thing I remember speaking to a banker one time, and he said the one thing about bankers is that we don't look for returns, we look for liquidity first, because we want to see how fast we can get our money back sooner than anything. Like that's the number one thing that they care about more than anything. Is it safe, and how fast can we get our money back? So once I saw the TFSA and everything, I was like, yeah.
Okay, so liquidity is really important to you, and the fact that it's tax-free when you're pulling it out, no tax consequences. Okay, I think that's a great reason. What about yourself, Kelly?
As Jermaine, I would also put it in the TFSA. And I would invest it very aggressively because I think that I still have time before I retire. So that would be the avenue I choose.
Okay. Yeah, I agree with both of you. So I agree the more aggressive you can in the tax-free savings account, the better, because you can get a lot greater returns and none of it is taxed. Two, if you are thinking of it for retirement purposes, then yes, both of you are young and you have, probably a greater than 30-year window to accumulate that. And if you chose to retire earlier, like in half that time, you can still pull on it as well, because you just have to monitor, where you have it and what you want to do as you recognize, hey, you know what, I don't have to wait till 65 to retire because I've been doing this for 10, 15 years. And, you've done not just the savings and the tax-free, maybe you've built a real estate portfolio or a business or whatever. And so you could choose to pull from it or use it to generate income, right? So you don't have to wait till 65. So great. Yeah, I think those are excellent ways to use it. I think it just all depends on each of our scenarios. I too would use the tax-free savings account. And I would probably invest it as much as I could in some, assets, like Kelly said, that are fairly aggressive, that gives me great returns. But because I have less time than Kelly, I might split my tax-free savings account and use the contribution into two different tax-free savings accounts. So I have one that I can focus more on saying, okay, you know what, that's for later on when I retire, but I want this one in maybe the next 3 to 5 years to help, take care of this gap. Because right now, one of my big focus is to generate more cash flow and income than investing and building for the future. I want some more income now.
But I was going to say, how I look at both of those are the TFSA is more for like, you want to invest your money, and then as you invest your money, RRSP is more like, because like the tax deduction, those are like the cherry on top for you investing. That's how I look at it. So the tax free would be like where you place your money, And then as you invest it, the tax deduction and the retirement savings are like the icing on the cake, depending on how you invest your money, where you invest your money, what you do with the money. Yeah.
Yeah. Okay. I agree. I don't use the RRSPs as much for me. I don't need it. I don't need the tax deductions. And I do have RRSPs and I do have LIRAs and, different retirement savings. But I've been focusing largely on just using it for my husband who needed the deductions and didn't have a pension plan per se, right? And so, yeah, that's a different way to look at it as well. For anyone that doesn't have access, they're employed and they don't have access to a pension plan through their work, the RSPs is your other way that you can accumulate. Because, I mean, OAS and CPP are not going to be enough. The maximum CPP and OAS combined is probably under $1,500 a month that you're getting. And if you couldn't live on $1,500 when you're, young and accumulating, building towards retirement, then you can't do it in retirement. So it's not a lot. And again, which one you choose is going to be depending on who you are and what you need. So you're going to choose a tax-free savings account, as you saw, Jermaine, you said it, because you want flexibility and you want liquidity. If you need it for short-term access, this is a great place. If you're looking for short-term access in an RRSP, it's not, because if you pull it out, you're going to pay taxes on the amounts that you pull out, and it's not advisable, right? If you're pulling it out in an RRSPs and you're doing it for lifelong learning or the home buyers plan, the HPP, I would say don't put it into something that is fairly aggressive and also not easily liquidated or will cost you, because that is also a factor. Even though you can pull it for those reasons, you want to look at what you're going to use it for. And if you ever think you're going to use it for something in the short term, even though you're going to put it back, maybe when you put it back, you can put it into something a bit more aggressive. So it's very few times you're going to need a short-term, low investment, low in risk, low volatility for RRSPs, unless you're saving it and knowing that you're going to use it for your first purchase of a home or going back to post-secondary as an adult. So the RRSP, you're typically doing it for the future, right? Something into the long term. And I would say long term for me is probably 5 years or greater. If it's going to be less, like something around 3 years, make it short-term style and choose the asset allocation, like the portfolio mix accordingly. You're not going to go very volatile. You're not going to go very aggressive for something that's 3 years or less, because you could take potential risk of losing a lot. You can also use both. It's possible to do both the TFSA and the RRSP. And you can maximize both accounts and be strategic over the time that you're accumulating, because depending on the goals that you're saving for and the needs that you want them to provide, you can use both. So I don't think you have to choose one or the other. You could do both, and you could choose the TFSA to be the secondary source. So you maybe use the RRSP if you're employed, get the rebate, then put that into the TFSA, so that you're doing both, right? If you need it. If you don't need the deductions and the reduced taxable income, then stay with the TFSA for now until that need arises, before you start to use the RRSP. Now, I'm not saying not to use the RRSPs, because if you have no pension income outside of, maybe the potential to get CPP, then you should be using the RRSP, because how will you finance your retirement years? Some takeaways is, I would say you have to assess your income, because everything is based on you and your goals before you decide which, the TFSA or the RRSP. You have to look at what makes sense for you and use both if you can, and be strategic, like I just said, to maybe use the maximum benefits that you can for tax purposes. So if you're getting the tax deductions and needing the tax deductions, use the RSPs. And then when you get them, use the TFSA. Consider investments that will suit tax advantages for each. And we spoke to, some of them, if you're investing in the TFSA, you're going to try to get things that will give, that would, like, if you were to think of it would earn the most or you would pay the most taxes, you put in the TFSA, right? Now, the RSPs, as I said, it's a unique strategy. If you don't have any plans elsewhere, then the RSPs, you're using it. But it doesn't matter whether you put, things that earn a lot of capital gains or dividends in their interest, because it's taxed as income in the future. So it doesn't really make a difference. But for the purpose of the tax-free savings account, put as much things that will gain that would potentially earn the most taxes, or you would get charged the most taxes, put it in the tax-free savings account, because no taxes is incurred up to the limits that you can. And always consult a financial advisor to ensure that you're getting the best approach for yourself. And if you have any questions, I'm always available to help, right? It may not be today, it may be sometime in the future, or it may be looking at something you already have. But it's really, really important to make sure that you're getting advice and that you're not just haphazardly making decisions for yourself. Really, if you need some personal advice, let me know. Reach out to me. I'm always available. And I really appreciate that you guys took the time to come and join tonight. I know that Cheryl knows most of this, and she's sort of in the phase where, she's depleting and using her retirement assets. So it isn't always the same for everyone that I work with. But, for us, especially for the two of you, Jermaine and Philly, you're really in the accumulation phase, and you want to take advantage of doing, even if it's the minimal, it's $25 a month or $100 a month, you want to try and make sure you stash away something. And it's really about discipline, right? And getting started as soon as you can and as early as you can. Okay. That's it for me, guys. I really appreciate your time. I hope you will be able to join us next week for the seminar on the Thursday. And and hopefully, we'll, I think I'll see, but we were speaking to focusing on taxation in April. So we'll come back to it and see, because that is a topic that is up and coming next, right? Our next big thing is April 30th, tax deadlines and, meeting those. So we'll be looking at that as an upcoming. And if you have questions before that, reach out to me and I'll help if I can. And of course, I'm not a tax expert, but I do know a lot, and I can help you with things